May 22nd, 2024. I thought the most important thing to realize early on in the day was how small the daily range was. Every once in a while, you'll get a day where the opening range is extremely small, like it was, and it'll just stay that way the whole day. But more likely, we were going to end up getting some sort of breakout. So if you look, we had a wedge here, a bit of an overshoot, but it was a wedge. You can see that the opening range, we're on bar 20, 22, 23, and the range is only 7.5 points so far, which is really, really small. If you just look at the daily chart, you can look, the days have been a little smaller lately, but 25, 25, or 24, 23, 32, um, 50, right? So what are the odds that we're just going to have a day that stays, within a 7 to 10 point range? Pretty low, probably, I don't know, 20% chance that that happens. So what most likely is going to happen is the daily range is going to double or triple. And the question becomes to the upside or the downside. So trades like 23, you can take and just your premise is that's the high of the day and we're going to triple to the downside. And you don't have the worst risk, you have great risk reward and your probability is not awful, considering the fact that you're risking, 3 points, maybe trying to make probably 20. So really good risk reward and not unreasonable probability. And I think especially, once we did get a breakout, but we ended up going sideways again. And even after this, we got the breakout and then reversed back into the range. What are the odds it's only going to be, a 12.5 range day? They're really not very good. So I thought, you don't want to force trades, but it was pretty reasonable, I think, to just set a stop order below here. And if we break to the downside, you just get short at the market at the low and just bet the daily range is going to double. It's a pretty reasonable thing to do. And you could set the stop to enter on the upside and bet the daily range is going to double as well. I thought we might try and test the all-time high, which is over here. But my big problem with it was we got a lower high, another lower high, another lower high, another lower high. So we're continuously getting lower highs. And when you're continuously getting lower highs and not quite getting back to the magnet, you can see we didn't quite reach it, we didn't quite reach it, we didn't quite reach it. Eventually traders are going to give up. And that's essentially what happened today. Traders were hoping we were going to get back up to that all-time high, which is 53.49, but we just ended up failing a couple of times. And at a certain point, traders get impatient and they just end up exiting. But yeah, I think tracking the size of the opening range was really, really important today. And being patient, just trusting that there's a breakout that's going to come. And the thing is, if you don't have to get in super early on it. You could sell, as the breakout is forming and still be relatively early in the trend because the potential is pretty large. So you don't have to force a trade. A lot of traders will end up forcing trades, and then by the time the one that they actually want to take comes, they're not mentally ready to take that trade, and they've already lost so much. Bar one, a bull bar closing near its high. It's a gap. We have a gap down, so potentially always in short from the gap, but I'd say still probably always in long from this. It was a wedge, 1, 2, 3. So we might have to get a couple legs sideways to down, but I think overall we're going to be pretty sideways. I thought that the high, obviously the all-time high, was the magnet for the bulls that I was pretty focused on, and for the bears, I thought the midpoint of the day, of yesterday, which was 53.35. So I thought if we got, essentially we were going to either try to rally towards the all-time high or just sell off a little bit towards here. The context on the daily chart wasn't that good for a big rally. Bar two, a doji bar, probably buyers below two, probably sellers not too far above. For the bears, they see a gap down, and now they have a low one short on bar two. But I sell below two? No, it's probably much better buy below. But not, I don't take those kind of limit order trades. So probably buyers below two. But for me, I thought better to wait. Big outside up on bar three for the bulls. So bears hoping that we have sell off and then we have one pullback two, and this is a two-legged correction, and then they're going to get some kind of sell off down. But more likely we have two bull closes and no bear close so far today. So I think we're probably going to end up going more sideways to up, but it'll probably be more on the side of sideways. The traders who bought below two, the buy was down here. It's not up here because this looks like a trading range open, especially considering you have a doji on bar two. You probably have to be expecting a trading range open. So traders are more willing to buy below two and probably scalp out somewhere above it for 3, maybe 4 points. And so that's why it's not really a good stop order buy above 3. It's a big bar with big risk, and you're buying high in what's probably a developing trading range. So I'd rather not do that. Bar four, an inside bar, a bull bar, closing relatively near its high. It's a high one for the bulls. Would I buy it? No. I think you're buying a high one at the top of a trading range if you're taking the buy above four. So I don't really think we've had very much that's all that good for stop order traders so far today. Bar five, more follow through for the bulls, but what are you noticing, right? We have a big bar and then a doji, a big bar and then a small bar, right? So essentially think of it big bar, small bar, big bar, small bar. So we have big bar, small bar, big bar, small bar. So that to me is one, two, and then three, the third leg up. And you can draw, the wedge 1, 3, 5. And it's a parabolic wedge on a lower time frame, right? So if we go to the lower time frame, it's going to look like some sort of parabolic wedge. Let's try a 2-minute chart. 1, 2, 3. A little more clear here. Maybe it'll be even more clear on the 1-minute chart. I think it's 2-minute chart's doing a good job of demonstrating it, but I just want to look at a 1-minute chart as well. Yeah, 1, 2, 3 wedge. So you get the point. It's a wedge, and does that mean that you sell below 5? No, there are probably buyers below 5 who are going to be willing to scale in lower if we do go down. But I would expect a couple legs sideways to down. 6, a bull or a doji bar. So we still have yet to have a bear close, and it's bar 6. So that's really not all that great for the bears. We're probably going to get back to the 2 high because bears who sold above there and scaled in haven't had a chance to get out. And this is definitely a trading range open. So I would imagine we're going to get back to that bar 2 high. So do you buy above 6? No, I don't think so. You're trying to get a breakout above the wedge, the 1, 3, 5 wedge. Generally, when you have a breakout attempt above a wedge, it's relatively 50-50. I think here that's relatively true. Seemed pretty neutral. But I didn't think that we were going to get a large breakout above it. I thought that the bulls just didn't have very much fuel so far. So if we're going to break out above this and go to that high, we probably need to get stronger. And instead, the breakout fails, and you get a bear bar closing below its midpoint on bar 7. It's a possible high of the day and a failed breakout above a wedge. But am I selling 7? No. I think if you're selling 7, you're probably selling bottom of a tight trading range, and I'd rather not sell the bottom of a tight trading range. If I want to sell, I want to look to sell a small bar a lot higher. And by tight trading range, I'm talking about basically these four bars, right? Not 3, but 4, 5, 6, 7 is what I'm talking about. And if you're selling there, you're selling the bottom of the tight trading range. So you might look at it and think, oh, I'm selling higher in the overall range, and you're not wrong, but I think the tight trading range is more important, and it's not all that likely that we're going to get a big test down here. So I think, whenever you get a trading range, what you want to do is look for a small bar near the top or to sell, or a small bar near the bottom to buy. Or if you're really skilled, scale in with limit orders. But if you're that skilled, probably don't listen to anything I'm saying. Bar 8, you can see traders, instead of selling below 7, they're looking to sell above 7 and fade the breakouts more or less. You can see on 7 we tested basically yesterday's close, and then 8. So I meant 8 traders are looking to sell the pullback of bar 7 rather than directly below it. 9, an inside bar. Bulls, they want to break out. So that you see we got the failed breakout of the wedge, and bulls want to try again and get a breakout, but instead we find sellers above bar 8. Why? Because there's consecutive bear bars. This is not that good. To me, this looks like a leg in a trading range. I don't know when, but I think we'll probably test back down at some point because this is a bull leg in a trading range. So we will most likely get a bear leg in a trading range as well. 10, additionally, this is still a tight trading range that started on bar 4 and probably became clear by 6 or 7. So we're still, if you're selling 10, you're selling too low in a tight trading range. And you are selling, double top, micro double top, but I think it's way too low. 12 or 11, it's follow through, and it breaks below the neckline of the double top, 8, 10, but it's not the follow through you wanted if you sold below 10. If you sold below 10, you wanted to see a huge bear bar closing near its low, taking traders by surprise and hoping that it's probably the start of a swing down. But instead, you get a bar that it's really weak follow through. And so what do traders do? Well, when you sell 10, you see you're disappointed 11, and you use 12 to buy back your shorts around break even. And that's what causes the bounce on bar 12. Am I buying above 12? No. I think that bulls want this to be a bull trend up to bar 5 in a 2-legged pullback, the first leg being to bar 8 and the second leg being to bar 11. And bears are hoping that, we're forming some sort of double top, head and shoulders top, maybe 5, 5, 7, 12. But I think the reality is this is just a tight trading range and you need to wait. And if you look at the daily range, obviously, we're only, the daily range is only 6 points at this point. So the daily range is probably going to at least quadruple. So there's really no rush to do anything. There's no rush to get in on either side here. If anything, rather than trying to take stop order trades, I would just I will first I wouldn't do this, but with how good the risk reward would be for either side, because potentially the upside or the downside, you could just sell the market and hope that the breakout quadruples to the downside, or buy the market and hope it quadruples to the upside. Again, I wouldn't do that, but there are probably algorithms that are willing to do that with wide stops. But I think the stop placement would be relatively tricky. So 13, a low one short. Bulls, they want this to be a bull trend, and 1, pullback, 2, pullback, 3. So the 3 push pullback, and they want to start a rally. Bears are hoping that 13 is essentially the head and shoulders top and the start of some sort of move down. 14, I think follow through for the Bears, but it's not even, it's a bear bar closing near its low, yeah, but it's not even, if you sold below 11, you're at a loss, or below 13, you're at a loss on 14. So, yes, bear bar closing near its low, but it didn't really do anything. You could argue it's a wedge, 6, 8, 11, and 15 was a breakout attempt below the wedge, but 15 traded above 14, making it possible that 15 was a second leg trap. Additionally, this is a tight trading range, so it's going to be a magnet, and we're probably going to get pulled back into it. So no real rush to do anything. And it's an outside down bar, yes, but a big tail on the top and the bottom of 15. So does that make me want to take any trades? Not particularly. 16, an inside bar, closing near its high. Do you buy above 16? I haven't marked. You probably can, considering the wedge, and you can argue failed breakup below the wedge. But you're buying right on a flat moving average and in a tight trading range. You are buying a little bit lower in the tight trading range, which is good, but you're still buying a tight trading range. So I would just rather not take any trades in this area. 17, follow through for the bulls, but again, this is not what you wanted to see if you bought above 16. It is follow through, but it's really not all that great. 18, more follow through for the bulls. A big tail on the top of 18. So not ideal. I think if you bought, you're hoping we get swing up. And the interesting thing that happens, so 49 is the all-time high, I believe, right? Yeah, 49 is the all-time high. So if you look, you get more follow through 19 and 20, but this is not the follow through you want, right? Why, if it's so bullish and we're going to the all-time high, is it not doing very bullish things? Why is there tails? Why does it look a lot more like a leg in a trading range and maybe a forming wedge, 1, 7, 20? So again, it's okay to be long, and it's really interesting because if you had bought and you had stopped below 16, technically the stop should be below 15, but if you had bought with stop below 15, and you bought 1 tick above the high of the 18 bar range, because a lot of times traders will buy 1 tick above or below, or sell 1 tick below the 18 bar range. So your stop, is 1 tick below 15. And your limit order is 1 tick, and your entry price is here. You can see the 1-to-1 is exactly the all-time high. And that's not a coincidence. The all-time high is the target that traders were going for there. So the computers basically created the risk to be so that traders could have a reasonable stop and have a probably 50 to 60% chance of hitting their limit order. Except for the fact that if you were taking that trade, what did you want to see happen on 20? You wanted to see a strong breakout and to see the bulls get stronger, closing decently above the high of the day and around 53.49, which is, or not quite there, but you wanted to see it get there within a bar or two. Instead, you get a disappointing bar on 20. And then what happens on 21? You get a doji bar. Why? Because a lot of the bulls who bought were not thrilled with how 20 ended up looking. And so they just exited their long, and that caused a doji bar on 21. When you're in a buy the close rally and you get a doji bar, the market starts to go sideways soon. And I think this is similar to the rally, 3, 4, 5, and you get a doji, 6, and then the market goes sideways. So you get the rally from 16 to 20 and that means on doji, the doji bar on 21 means the market is probably going to start to go sideways within 3 bars. So really not all that great when you see a doji, and the buy the close rally really wasn't all that great to begin with. So I have a lot of problems with staying long up here, and which is exactly why traders dump on the close of 22. If you were still long and you didn't exit during 21, traders see the doji bar and then they exit on the close of 21 disappointed, and that's what causes the initial sell-off. 22, it tries to pull back to the bar 20 close, but not quite able to. Or sorry, 23, it tries to pull back to the bar 20 close, but not quite able to. There will be some bulls always trying to buy the moving average, especially in a trading range and willing to scale in lower. But 23, a bear bar closing near its low. There was definitely a buy climax from 16 to 20, so that is the problem for the bears. However, it's definitely a reasonable wedge setup. And again, my big thing is you now have a bear bar closing near its low, and it's a reasonable swing sell, and the daily range is only 7. So you can probably risk, 4 points and just set some limit order for, I don't know, you're trying to get the daily range to 20, maybe 25 points. So you just try to basically make like 20 points and put it somewhere way down here. That looks kind of ridiculous, but it's probably a reasonable thing to do. And just bet that the daily range essentially triples and that it's going to be triple to the downside. Doji bar on 24, so it's not the best follow through. Your premise is valid, and again, the thing I like about trades where if you're taking them and you're thinking, okay, my premise is this is the higher low of the day, is there's not as much thinking involved. There's not as much management because your premise that 23 was, or we've seen the high of the day by bar 23 remains valid until we trade above the place where your stop would be, which is the 20 high. So you can sell 23. You get a doji follow through bar 24. The day's had a lot of trading range price action, so we're probably not going to go straight down. We might have to go a little more sideways first. 25, more follow through for the bears, but a tail. You can see we touched the 15 close, and that's where we found buyers because some bears sold the close of 15. You can see 13, 14, 15 technically sell the close bar, and those traders were scaling in higher at the all-time high or at the new high, betting that this was all just a leg in a trading range and we were going to come back to their entry price. 26, an inside bar. I think it's just a bad high one in, a more credible bear trend than a bull trend. Bulls are arguing we found buyers at the 16, around the 16 open because it was the bottom of the buy climax. And in a trading range, buy climaxes are magnets, which is true. But instead, I think that the channel down was pretty tight and the bears have a more logical argument at this point. I thought if we were going to rally, we probably would have done it already. I thought that the rally up to 20 was, mostly the chance that the bulls had. Now that we have a bear channel, it's just as tight. I'm not really expecting much from the bulls. Essentially outside down 27, but really just sideways here. I think I would rather wait and see what happens. Again, I think, if you're not short yet, wait for a bear bar closing near its low. But if you're short below 23, it's totally fine to just stay in your trade. Definitely, I would not personally exit above 26. I'd just rather wait. It's probably a minor reversal. 28, a bear bar closing near its low. A good sell. You're betting for, again, the downside breakout and the measured move. We've probably got some sort of measured move down on 29, considering how big it was. So not quite there, within 2 ticks. But the point being, okay to sell below 28. And you can see if you sold below 28, you were able to pretty quickly make a 5-point scalp. And on a day like today, if you're able to make 5 points in 5 minutes, most traders will just take the profit and run. And that's exactly why we got such a big tail on 29. And then the bears who didn't exit, they were hoping that 29 was going to close on or near its low. And when it closed disappointing, a lot of them bought back their shorts. And if they didn't buy back their shorts, they would see bar 30 and think possible wedge, parabolic wedge. Expanding triangle, 1, 7, 20, and 1, 29, and they would buy back their shorts above bar 30. So, you can even argue this is part of the expanding triangle. So most traders buying back shorts above 30, and we end up getting some follow through 31. It is follow through, but it doesn't close very far above bar 30's high. Some traders who were worried that 30 was going to be a trap saw that 31 close basically right where their entry price would be. You can see. So if you bought above 30, this was your entry price, and then 31 closed at the same price. So they'll think, well, now I have follow through for the bulls for bar 30, and I didn't have to pay any extra money. I didn't have to pay any extra money. I didn't have to wait to get in higher. I can get in at the same price with more information, which a lot of times can be suspicious, but I think pretty reasonable thing to do to buy the close of 31. And you get, so it's buy the close 31, probably buy above 30, buy the close 31, buy the close 32, 33, but now you're getting high, right? So you're relatively high in this range at this point. 32 was a good bull bar, but a big tail on the top, and you're near the moving average, reminding you this is probably still a trading range. And 33, good follow through for the bulls, but now the risk is big. Remember, when you're in trading range, you want to see small bars near the tops of the range and and small bars near the bottom of the range, and you want to buy the small ones near the bottom of the range and sell the small ones near the top of the range. You don't want to be in a buy the close rally in the middle of a trading range like we are on 33. So the problem with 33 is we're probably going to go sideways if you take the buy because we're in the middle of a relatively tight trading range. I think what was interesting was that if you bought, so the magnet up here, and you had bought, let's say, I don't know, somewhere in here, but what's the midpoint, right? The midpoint was right here. So I thought why we were oscillating is because you put a stop down here, the low of the day, reasonable thing to do. We're probably always in long. And you put a limit order to take profits at the all-time high. And this is the midpoint of those things. So what's going on here is traders are fighting over if we're going to get the rally or if we're going to get the sell-off and down to here. So I thought that's why we started to go sideways here. 34, a bear bar closing near its low, but not really worth selling after so much of a buy climax. I think, the odds are relatively neutral at this point that we get to the all-time high or get back down to the 29 low. 37 or 35, a disappointing bar. It was an outside up bar at one point, but ended up selling back off. Again, I think this is now a trading range. An inside bar on 36, bears see a low 2 short, but I'm not selling a bear bar or not selling a bull bar low 2 in the middle of a tight trading range. Again, at this point, the daily range is still really small. I would just rather wait and see some sort of breakout attempt before I do anything. 37, a big, you can see we got buyers below 36 and pulled back. Not that surprising. The bulls just see a pullback and they're thinking that 34 and 37 is a two-legged correction in their bull trend. We might have to get a third leg up here, and you can see 38, arguably, a high 2 for the bulls. I would say it's a high 2. Bears hoping, still pull back in their bear trend. They're hoping this whole thing is a pullback from the sell-off that started on bar 22. But I think that we're probably, again, I think the odds are relatively neutral. And bull follow through on 39, but might be a third leg up. First leg up, 30 to 33. Second leg, 35, 36. And 38, 39 is the third leg up. So we might instead have 3 legs up here. So am I buying if we go above 39? The argument would be that the risk is smaller and you can put a stop below 38 and you want to get to the all-time high. But instead, we never trigger above 39 and we get a big bear bar closing near its low on 40. Do you sell 40? I don't think so. I think a couple of things. I think one, we're definitely getting back to the 29 close today. I thought, it removed the bulls' chance to quickly start to race to the upside to the all-time high. So I thought 40 was a really interesting bar, but it's hard to sell because the channel up from 30 to 39 was pretty tight, and that's probably going to get a second leg up. So if you're selling it, you can't put a stop above 40 because that's a skunk stop. So you probably have to have a wide stop and be willing to scale in more above the bar. Disappointing follow through on 41, which is relatively expected. Again, you have bad risk reward selling below 40, going for the bar 29 close. And so a lot of traders are not going to take that because the bar is big and the tight channel lowers the probability. Additionally, buying the close of 39 wasn't smart, but it wasn't the worst thing in the world to do. So we're probably getting back to the bar 39 close, or at least the bar 39 low. So that also makes me suspicious of selling down here. And, again, the reason we're probably getting back to the bar 39 low is because it's trading range day. It's clearly a trading range day. So traders who trade on limit orders and scale in are probably going to be able to get out of their trade with a profit. So we should get back to at least the 39 low. 41, a bull bar, but a big tail on the top and on the bottom. Bulls, they want to try and get some sort of breakout above the wedge. Bears, they want, they know we might get a pullback, but again, they're still hoping that this is the high of the day. Still theoretically probably reasonable to be short from 23, just hoping that we, the range gets a lot bigger. But sometimes it won't. Sometimes it'll just stay within this range. 43, 42, a doji follow-through bar. Basically got back to the close of 40 and bears bought back shorts. 43, a bull bar, but a big tail on the top, so not really as bullish as it could be. More follow-through for the bulls on 44, but a tail on the top and a tail on the bottom. I think that this is, we're just going more sideways, and more follow through on 45, but right to the 39 close. If you bought the close of 39, you were obviously not happy with 40. You probably scaled in lower, and now you're looking to get out, and that's exactly what happened on 46. 46 is a wedge. You could look at it one of two ways. I think you could look at a wedge 27, 35, 39. You could look at it as a wedge a little tougher, but 30, 35, 39. Or I think you could look at it 34, 39, 46, which makes probably the most sense. But if you do look at it, I thought this made the most sense. 27, 35, and 39 made the second most sense and less credible, but three legs up, you can see here. So a lot of computers will still look at it that way. So you can look at bar 46 as either a failed breakout above a wedge, or you can look at it as its own wedge. Either way, I think we're probably going to get a second leg sideways down. Do you sell below 46? Yeah, I think it's a good sell. There was a bit of a buy climax here, but I think traders will be sufficiently disappointed that they're going to want to exit. And you can see 47, kind of disappointing follow through. And you can see a lot of the traders, they were worried about getting trapped selling 46 on 47. And they did kind of the same thing they did here, where 30, they liked the fact that they got follow through that they wanted, but they didn't have to pay extra money for the information. Here, traders who sold below 46, you can see 47, they got follow through and they didn't have to pay any extra money for that information. And so we end up getting follow through for the bears 48. Bears start to sell the close. It's sell the close 48. Another interesting thing about bar 46. If you had taken the sell below bar 46, what do you need? What's your goal? Well, it might be to make 5 points since it's a trading range day. And what's an obvious magnet? The 29 close. So you sell below 46, trying to make 5 points, and it needs to go 5.5 total points for you to make those 5 points. And look where it goes, 5.5 total points, right to the bar 29 close. And your risk is pretty small, right? So you're getting better than 2-to-1 selling below 46, going for bar 29 close, and I think at least 50% or 40% chance you get there, if not more like 50. So pretty reasonable to take that short. And then we get 40-8, a sell the close bar, good for the bears, probably going a bit lower. 49, probably another sell the close bar, probably still getting to at least the 29 close. Could be the breakout, but it's better, I think, to not, it definitely could be, but maybe big head and shoulders, but I think better to not, bet on anything. I think you should take a piece off once we get to here because of how much trading range price action you get. And then you get bar 50, huge bar, 10 points. This is probably the breakout. You could argue it's a wedge, 129, 50, but I would not look to buy anything down here. With how big this is and how small the daily range has been, I think the breakout's starting now. 51, follow through for the bears. You can sell it, but we're probably going to get a pullback because the risk is so large. You theoretically have to put a stop above bar 46. So we're probably going to pull back for a few legs sideways to up. 52, a bull bar, but a big tail on the top and the bottom. I think I would rather wait. You don't really have to exit above it, maybe a couple points. And inside bar 53, a low one short for the bears, but really not all that ideal selling a doji bar this low. Bar 54, the big bull bar closing near its high. Good for the bulls, but I think probably sellers not too far above. But bears will exit above 54, which is exactly why bears sold the close of 54. It was a tight trading range, so really not good to look to buy above this bar. I would rather just exit my shorts and look to sell again. But since traders knew other traders would exit shorts, they still wanted to sell because they wanted the daily range to get larger. So a lot of traders sold the close of this willing to bet. And again, you can sell the close of 54 and just put a stop one tick above it. So you're risking 2 points, just betting the range is going to continue to get larger, 2 ticks. And it's not much risk. And it doesn't work very often. But when it does work here, you can see, you might have made 10, 15 points here in that 5 minutes. And that's going to make up for the next 10 times you take that trade and you lose it. So you don't win very much when you take that kind of trade, but you win very big when you do, and you lose very small when you don't. An inside bar on 56, probably better to exit above. We might have to test back into the final flag from 52 to 54 and 57, another inside bar. Do you sell below 57? You probably can, but it is a final flag. So selling below 57, the market needs to go pretty quick, and that we're probably going to get back to, back somewhere in here since it is a final flag. Additionally, sell climax, pullback, sell climax, pullback. Maybe one more sell climax, consecutive sell climaxes, and then that's probably the end of the trend. So while 58 is still follow through for the bears, big tail on the top, and a huge bar 59, but again, a big tail on the top, this is probably becoming some sort of, sell climax. And a big bear bar closing near its low on 60, but I would not sell 60. It's consecutive sell climaxes. You're selling extremely low in this trend, and it's really not a great idea because we had so much trading range price action earlier in the day. Sure, obviously, this overrules it, but I thought one of the magnets we were testing, I mentioned on the daily chart, I thought this was a reasonable sell. That, you could sell below this bar and we'd probably get back below it, and you can see that we did. And that was somewhere in here. So that's what caused this big tail was the traders who were waiting. They sold, right here. So they sold one tick below here. You can see that's probably what was causing a lot of that, in my opinion. 61, disappointing follow through because 60 was more of a profit taking bar, and another doji bar on 62. A bear bar 63, but I'm not, I think probably buyers below 62 more so than sellers. Not that I would buy below it, but I think most likely not too much more to the downside. You need a wide stop if you're buying below something like that. So, if you sold below 60 and then you saw 61, I would just get out above 61 or during 62, because if you're selling a trade that dangerous, that low in the trend, you need it to work really quickly. And traders give up, and that causes 64. 65, a bear bar closing near its low. You could argue this was a bull trap, but we're still way too low. I think we need a deeper correction. 66, you can see buyers below because not a lot of traders willing to sell. We need a few legs sideways to up to the moving average. So 66, outside up, triggers the high one buy above 65. Follow through for the bulls, 67. Good, but I don't really want to buy. If I want to buy, I'm back to trading range mentality. So if I want to buy, I want to buy a lot lower. 68, waning momentum. You can see as we're getting towards the moving average, we might be getting towards the top of this possible trading range. And, the 58 low, which was a breakout point. 69, a bear bar closing near its low. You could argue it's a wedge pullback. 61, 64, 69, or 68, I guess. And you could probably sell below 69, but the downside is probably limited. You can see we tested back to the 64 or the 64 open, which was the beginning or the most recent buy climax low, and then a big reversal up 71. Do you buy above 71? I probably wouldn't. You can, again, wedge 61, 64, 69. So you can argue breakout above a wedge, and we're probably going higher, or I guess pretty 50-50. But not a lot of traders eager to buy that big of a bar near the moving average after that big of a bear move. 72, an inside bar, and then it's a high one for the bulls in what they want to be a bull trend. I think tough to take that buy. And then a big bull bar closing near, not near its high, but well above its midpoint, 73. But to me, this looks like really climactic. Maybe we got the measured move. I don't know. Yeah, one ticket. So that's, probably what that was. The measured move up of the wedge. When you break out above a wedge, the goal, or a lot of traders want the measured move up of the wedge. And when you get a breakout above a wedge, it's generally pretty 50-50 that with the stop below here and you enter here that you're going to get the measured move up. So there's not a ton of edge, and you need to wait to see how the breakouts look usually. At least in my opinion, you should wait to see how the breakouts look instead of buying above stops on stops above wedges. It's all context dependent, but you need to have really good context in order to do something like that. 74, a bear bar closing near its low. Maybe this was a bull trap, and this is not a bull trend. It's probably a trading range, and 69 was a big bear, or 70 was a big bear bar closing near its low, right? So it was theoretically reasonable to sell the close of 70. I would not do it, but it was theoretically reasonable to sell any big bear bar in a potential bear trend. So that's probably one of the reasons why we vacuumed back down to that 70 close. You get follow through for the bears 75. I think pretty likely we're getting back down to here, and more follow through for the bears on 76. But how much is left to the downside? If you're selling down here, you have to realize that the target is the 70 close, and we're probably going to get some sort of buyers there. However, something to keep in mind is that this is a trading range, right? When you see 71, 72, 73, you have to think trading range. I assume it was a little deeper than a 50% pullback of the whole move. A little bit. We closed at a 50% pullback of the whole move. So the reversal up on 77. Do you buy 77? Yeah, I think 77 is a pretty credible buy. For the reasoning, my reasoning is this. Whenever you take a reasonable buy, there is an 80% chance if you scale in, you're going to be able to get out of your trade at break even, the break even price of the two pieces, and 60% chance it'll get back to your original entry. So it wasn't good to buy the close of 73, but it wasn't unreasonable either. So traders, I think 80% chance we're getting here, and 60% chance we're probably getting back up to here. So even more so than that, it wasn't good to buy the close of 54, but some traders would have argued, well, we have a big wedge and we're probably going to get something here, and it's a big bull bar closing near its high. Pretty much anytime you get a big bull bar closing near its high, it's going to become a magnet. So I think it's reasonable to think that buying above 77, you have an 80% chance of getting, about right here. And probably a 50, maybe a 50% chance that we're going to rally straight up all the way to bar 54. And you can see that we did. And funnily enough, the bulls who bought below 30, this was a big trading range day, if you think about it at the end of the day. The bulls who bought below 30, once we became a trading range, you have to start looking for open gaps and wondering if they're going to close. And if you bought below 30, it wasn't an unreasonable thing to do as this was falling, betting that this breakout was going to fail because breakouts have been failing today. And the traders who did that, they, even if they scaled in all the way down, they were able to get out. But again, it's really hard to do things like that, and it's mostly theoretical. But it's good, good to know for trading. For stop orders, I thought 23 was good. 16 was probably fine, but I don't really want to do that. 23 was good. 30 was probably fine. 28 is sell the close. 30, 31, buy the close. Probably not buy the close up here. Probably back to trading range, buy climax, and in the middle of a trading range. So wedge, I wouldn't sell 40. I think that 46, really credible trade. 48. But I'm not sure how much of this, in theory, if you sold 46, you didn't have to exit anywhere in here, but it's hard to sit through these huge climaxes and not take pieces off. So, I don't know. Probably sell the close 50, 51. You don't have to exit in here. You would exit above 54, but it never triggers. Maybe sell 57, but really dangerous, but probably okay to do. I would not sell 60. I probably wouldn't do anything in here. You could probably sell 69, but I'd rather wait. I wouldn't really buy here. I think you're buying, it's probably okay, but I would just rather wait. You can probably sell 74, and you have to get out somewhere down here. Probably not get out above this bar. And then I think buying above 77 makes sense. And yeah, that's it. On the daily chart, I thought, to me, again, this screams trading range. So I do think this is still an exhaustion gap, and we're going to get back to this high. Yeah, that's pretty much most of my thoughts on the daily chart. It was big double top, or it is a big double top, higher high double top. But I ultimately think this is a trading range, and you can make the argument if this is a trading range, all the gaps should close, right? So we should get back, in theory, get back down to here. Obviously here, if this is a trading range, maybe here. So we'll see what ends up happening. It would take a while to get back down to here, but because of how tight the bull channel up is. So I think that ultimately we're probably going higher because this is a really strong channel up and following a huge channel up. So this in general is just stronger than that. So I do think we're going higher, but we might have to get a pullback first. Weekly chart, today is Wednesday, so 2 days left of the week. Pretty small week so far. Bulls want a bull close to get some follow through, and so they can say the breakout above this high was successful because they have consecutive bull closes. But I don't think that, did last week close above the high? Okay, so yeah, this week closed above the high. So bulls want consecutive bull closes above the all-time high. But we'll see if they get it. If the bears can get a bear close, they can argue that the breakout failed. And yeah, that's the day.